Hello, and welcome to Inderes TV. Neste reported a quite disappointing result last week, and now I'm in the studio with Analyst Petri Gostowski to discuss the result. Hello, Petri.
Hey.
So, as I said, it was a clear disappointment, Q4. What was behind that?
Well, it all comes down to the Renewable Products segment. The whole year 24 was tough for the segment, and expectations came down throughout the year, but obviously Q4 was even weaker than anticipated. Expectations were low regarding the renewable products sales margin, but given the tough market circumstances and especially the operational challenges they had, for example, a fire at one of their refineries and so on, these brought more costs than anticipated and actually weakened the margin more than expected.
Okay. Was there anything positive in the report?
Well, I mean, if you look at overall, the two other segments, they performed as expected or slightly better. The market circumstances have changed there to the weaker side, obviously, also given where we are in the broad picture of things. But I mean, they're doing fine. The businesses are good businesses, but obviously, the majority of the company's value comes from the renewable products. So it's a minor detail given the whole big picture.
Yeah. Okay. So they also announced the conclusions of the full potential analysis. Can you elaborate on that a bit?
Yeah. So obviously, the market outlook has changed drastically in renewable products, and then this is why they kicked off this program with the new CEO, and like they stated at the very beginning, it was about costs and investments and commercial actions. So the end result was kind of like you would expect, cut costs a lot. That's what you have to do to improve your profitability. Rethink investments, prioritize investments, and then try to gain more speed in the commercial side. So make sure you get to the right customers in the right way. So kind of like changing a bit the go-to-market models and stuff like this. I mean, yeah, the profitability has come down very significantly. You have to take significant actions. They have a cost-cutting program and an EBITDA run rate improvement program. It's all 350 million is the goal to improve their earnings, out of which 250 is cost cuts. Obviously, cost cuts is something that you can manage fairly not easily, but they are more manageable. But then on the commercial side, it's given the market circumstances, it's much of a bigger challenge to and there's everyone else chasing the same customers given the market situation. So we have to see what comes out of that. But yeah, at least significant cost cuts are coming. On the investment side, I mean, yeah, you can do prioritization, but you're in the middle of a huge new refinery expansion investment in Rotterdam. Costs now 2.5 billion because they extended the investment period with 1 year. So they're trying to, even out the investments a bit. But I mean, it's a huge investment, and you can't really stop one of that size investments. So I mean, they did change the overall picture a little bit, but there is a huge investment going. You can't run away from it.
Yeah, sure. So there was also a capital markets update given in connection with the result. What was the main message there then?
Well, one part was obviously these cost cuts and new plans for the investments and so on, and then the other part was an update on the market outlook. They had updated figures regarding the future capacity and demand of renewable products. The big picture is like we knew it. I mean, there is significant overcapacity this year. Given that the market the demand is growing, it will eventually turn. So how things stand now, it looks like there will be more demand than capacity, say 2030, and I can really see that happening because where we are at the market, it's not a market where anyone's going to invest because you can't really make profits there. So it's very common for any market that it's going to balance itself out. But the question has been lately, when is that going to happen?
Right.
And it doesn't look like it's going to happen in the very near future. But this is obviously something we have to follow all the time because there's regulations change and regulation drives the demand. So the overall picture can change. But for now, it looks tough.
So it's a waiting game to see when it starts or when we can see an improvement. You already mentioned the overcapacity. What's your view there? Like you said, it's not going to correct itself soon, but there is hope that it's going to happen down the line.
Yeah, there's actually two drivers. I already spoke about the demand growing. That's one significant driver. It will take time, but I'm confident it's going to happen. I'm not going to say I'm sure because you shouldn't say you're sure about pretty much anything when it comes to investing and estimating. And then there's the other part is that a big part of the players are losing money currently. And what we know of other industries and other time frames or whatever, it just doesn't last forever. I mean, we're gonna have companies going broke if they're losing money. So what tends to happen then is that some people they could go bankrupt, they could shut down their production or shift production to something else. So that's also a component that might kick in at some point, even with a bigger impact. Super hard to estimate how it will play out, but I think that could also, and the longer this current situation that they are making losses holds, that increases the probability of that happening.
Right, of course. Neste has a clear margin premium. Is this still sustainable, or do you see it changing?
Yeah, I mean, there's a lot of components that impact the premium. One big is that they are operating globally, so their production in whether it's Singapore, in Rotterdam, in the Central Europe, here in the Nordics, and in US throughout the JV. So that gives them the availability to optimize their sales depending on which market has the best outlook. But the thing is, currently the biggest part of the overcapacity is in the US, so that market is a bit tougher. There's other dynamics kicking in also, like changes in regulation there. So I'd say for Neste, the market there looks not very tempting, to say the least. But the thing is that this is such a product, you can ship it from the US to Europe. So I mean, while Neste will be looking for better markets somewhere else, I'm sure the competitors will do that too. Obviously, some might not have production in Europe, so it's a bit different game there. But I mean, it is kind of a global market. Then Neste has built kind of like their forefront in sourcing raw materials, and the pre-treatment capabilities are better than average players have. So you might be able to get a premium over there also in the future. But then if you think about the overall market margins, for example, in the US, and the fact that actually local production might gain some tax benefits or production credits, so to say, in the future, and Neste has smaller capacity there than they used to sell in volumes last year when they were bringing it from Europe. So that kind of changes the margin picture what comes to where your product is produced. So looking at only one part of the margin equation, you might say, yeah, there is a room for a premium. But then if you take everything into account, I see it going down clearly.
Yeah, okay. Then we kind of touched on this a bit, but the outlook for this year and maybe even next, what's your view on that?
Well, if we start with what Neste is guiding, I mean, last year they changed their guiding, so going into 24 they changed. Previously they had guided for the next quarter on their two biggest segments, guided on volumes and margins,
right?
And then last year they started guiding the whole year in volumes and margins, and it was very tough, so they had to change their guidance many times. So it was kind of expected that they would change their guiding policy for this year. Now they only guided volumes in both segments, and they guided growth. But if you look at last year, thinking about the production issues they had in renewables and the kind of ramping up Singapore and Martinez, it's obvious that the volume should grow. So there's nothing really to build on that guidance. And then if you think about the oil products, the other bigger segment, they also had the huge turnaround in Portugal where they had to bring down their operations. It happens every 2-3 years nowadays. So obviously you have kind of the benchmark from last year is kind of low in both businesses. So volume growth is obvious. The question is about the margins. We know that in oil products the market is pretty good. I mean, it's not something it was a few years ago when the margins were historically high, but it's a good business.
Right.
The question is, where's the renewables margins going to be? There's a lot of changes. What I'm referring to, I just told about the regulation changes in the US, given the overcapacity. It looks very tough in the short term for the margins. The question is, Neste estimated 6 million tons of overcapacity this year. Given the market growth, it's going to be something a little bit smaller, most probably next year. But does it look like a market where you can make healthy margins? No, not currently. I'd expect it to be a bit more or a bit better than this year, but we'll have to see. It looks tough in terms of margins in the renewables.
Yeah. Okay. And then finally, the valuation and recommendation. Where are we standing now?
Yeah. So currently we have a reduced recommendation, and actually all comes down to the fact that given that we took down our renewables margin estimates for the next. Well, for the short term and for the midterm. So we previously argued that the midterm valuation looks very tempting because the market will recover. And now we took our expectation down on the recovery. So the valuation is, I mean, it's not high if you look out 3-4 years. But I think that's a very long time to wait, given that the short-term valuation is very high. And also the risk factor, I think, is increased or has increased due to the fact that cutting down the cash flow estimates from the next few years, it brings actually the leverage up quite drastically, and given that the earnings are low, the company is pretty levered compared to where their earnings stand. So I think the risk profile has changed somewhat.
Yeah. Okay. Thank you, Petri.
Thank you.
So a tough year and problems in renewable products, but you can read more in the report at Inderes.se.